Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with March 2017's Charts on the Move. When viewing the whole of Q1, it turned out to be a great quarter for U.S. stocks as they continued their climb higher. But like the old saying about March's weather, the quarter went in like a lion and out like a lamb, as you'll see in my first few charts. Starting with a look at the quarterly returns for the U.S. stock indexes, we see the Nasdaq continued its leadership as it gained almost 9%, followed by the S&P 500 index at about half of that. The industrials lagged the broader 500 index, rising 4%. The NYSE settled in with a 3% gain, while small cap stocks brought up the rear, climbing just 1.5%. Taking a look at the same components, but just for the month of March, we see the Nasdaq was again on top, eking out a fractional gain, while the NYSE and S&P 500 both lost about 1.4%. The small caps tried valiantly to rally mid-month and recouped a big chunk of their earlier month losses. They fell 2%, while the industrials were March's biggest loser, shedding a bit more than 2%. Taking a look at a breakdown by U.S. stock sector for the quarter, we saw consumer cyclicals and technology the big winners, up over 3% and 5%, while financials and energy were a drag on market gains as they came in with losses of more than 3% and 12% respectively. It's pretty easy to see in my next longer-term chart of the U.S. stock market via the S&P 500 index. It's in a clear uptrend as prices above not only the rising blue trend line, it's above the blue horizontal prior breakout level, and also above a rising 200-day moving average. In the upper pane, we could see that we were slightly overbought and in need of a pullback, which is what March's decline was trying to unwind. The question is whether that pullback is done. If not, I would expect this 2200 level here to be a potential termination area for any further decline due to the confluence of support. With so many divergences showing up on the daily charts I review, I'm skeptical this pullback is done. But before we move on, I want to point out how during this initial rise and then the subsequent breakout from this consolidation, the red 200-day moving average has acted as support. Almost every time the index pulled back, it acted as a trampoline as price bounced off of it, reversed course, and then moved higher. On this chart, this year-and-a-half long consolidation was the exception, and it was one of the main reasons for my caution and risk aversion at that time. Only in hindsight did we find out that it was eventually going to resolve to the upside, and the caution was not warranted. Moving over to bonds, using AGG as our lens into the U.S. bond market, we can see this bond uptrend peaked mid-last year. It started consolidating for a few months and then began its decline in earnest, breaking right through this uptrend support line and then found a bottom right where we would expect to here at prior support. While it may have found a bottom, price punched right through this red 200-day moving average and it currently sits below it. Notice how as time has passed and prices remain below it, the average has flattened and then begun to curl down. As we saw with the prior S&P 500 stock chart, that average acts as support as prices are rising, but it also acts as resistance in a bear market as prices begin to fall. For this reason, if we cannot recapture that level and remain above it over the next coming months, I would expect we are in for a much more meaningful correction in U.S. bonds. Until then, though, this recent decline should be only viewed as a normal pullback within an uptrend. My next chart is one that I follow, but I don't think I've shared it before. It's the ratio of high-yield junk bonds to U.S. government 20-year Treasury bonds. The direction of the ratio is a reflection of the mood of investors and their willingness to take risk. If the trend is up, junk bonds are being bought and investors are shunning the security of government bonds. Conversely, if the trend is down, investors are risk-averse and they are selling the more risky junk bonds and buying government treasuries as they are viewed as a safe haven. As you can see, the ratio found a bottom in February of last year and has been since moving higher. The ratio is currently consolidating just under a very important support resistance line. Looking in the upper pane, we have bearish negative momentum divergence, which says we need further consolidation or even a deeper pullback, which would be reflected in lower junk bond prices, higher treasury prices, or a combination of both. There is no coincidence that this consolidation is happening exactly as stocks are doing the same thing, as junk bonds returns are highly correlated to those seen in stocks. My next chart is another one that I follow closely, but again, I don't think I've shared it before. as it is an interpretation of the bond market's view of inflation. You remember inflation, don't you? The 1970s? Jimmy Carter presidency? No? If not, I can understand why, as you would have to remember way back when the dinosaurs just became extinct, and of course not everyone is as old as I am. But hey, I digress. Now let's get back to the charts, will you, Chuck? This chart is a ratio of TIP bonds, which are Treasury inflation protected government bonds, versus AGG, the proxy for the U.S. bond market. The takeaway here is that if the ratio is rising, the bond market views inflation as a concern. If it's falling, inflation is not a worry. As of now, the bond market is sitting up and paying attention, but not yet worried. As you can see, we are officially only in a sideways consolidation, being exactly at the same point where we were more than 2 years ago. But what drew my attention and the reason I wanted to show this chart is the fact that the ratio found a bottom early last year, just after a positive divergent oversold signal triggered. Since that time, the ratio has created higher highs and higher lows and is now above a rising 200-day moving average. Until it breaks above the red horizontal resistance, though, no action is warranted, but watch out if it does, because bondholders would likely be in for a very nasty beatdown. If you're watching for inflation signals, there's no better place than observing what the commodity indexes are doing. As we know, commodity prices are highly correlated to inflation. As you can see in my next chart of the CRB commodity index, it's about as boring and uninspiring as a chart can be. There are no rising prices or positive divergence hinting that a reversal is in our future. Its price is well below a falling 200-day moving average and currently is attempting a half-hearted oversold bounce. Until this can form a series of higher highs and higher lows, push past the 2009 prior bottom here, and then challenge the 200-day moving average, commodities are providing little ammunition to the bond market's thesis that inflation may be near. One important component I look for when scanning charts is divergence, as it represents the potential for either a trend reversal or a short to intermediate term counter-trend profit opportunity. Divergence shows up on all time frames and across all investments. Divergence is nothing more than when the price of an investment is trending in one direction, the momentum of that investment has begun to move in the opposite direction. To illustrate some examples, let's take a look at my next chart of that of West Texas crude oil. There are 3 areas I have highlighted where price is falling but momentum is rising. Starting from the left, the first divergence here marked a trend reversal as oil bottomed and went on a tear, climbing 100% in less than 6 months. Moving to the right, the second divergence signaled that a bottom was in and oil went on to rise 30% before topping out. At the far right, we see this third time here where oil's price is again diverging from momentum and has set up oil for another possible opportunity. Since we're in the middle of this current move, only time will tell if it'll be as profitable as the other 2 signals. In case you're wondering, divergence also works well to warn when investments have topped and are in need of a pullback, as you can see in my next chart. This is the same chart of the West Texas crude oil as before, but this time with the bearish momentum divergence occurrences highlighted. As you can see, 4 signals occurred over this 2-year period, giving advance warning of these 4 declines. From the left to right, the declines were 57%, 24%, 19%, and 14%. Like all things in technical analysis, divergence is not perfect. It is open to interpretation, and even though it is clear as day in hindsight, I have found only a small percentage of investors are able to profit from their signals. With that as a backdrop, I have 2 more price charts I wanted to show as they are new additions to client portfolios. The first is of OIH, which is the Energy Sector Service Company ETF. As you would expect, it tracks the price of oil pretty well. This was added because of its dividend, the positive divergence here, and priced once again using the red 200-day moving average as a trampoline to reverse a short-term downtrend. In spite of the fact that the fundamentals for intermediate-term oil prices are modest at best, the good news is many of the companies within this ETF have restructured and are much better able to make decent profits even in a weak energy price environment. My final price chart is that of the Mexico Stock Market ETF. This contrarian play is one that I've been watching for months. I wish I had pulled the trigger earlier when the buy signal first triggered, but I let the noise coming from the political ranks distract me from my process as I deemed it too risky. As my analysis showed, price created multi-time period positive divergence and then bottomed in January of this year. Since then, price has moved strongly through the 200-day moving average and is approaching major overhead resistance here at T1 during this 25% upside run. Momentum is currently overbought and is in need of a rest before it attempts to bust through T1 and retake prior highs. Any pullback would allow the 200-day moving average to catch up and act as positive support and a springboard if it were tested from above. As such, some near-term consolidation and backing and filling would be very constructive. If that were to occur, and because of the upside potential is very attractive, any retest and hold of the 200-day average would offer a very constructive area to add an additional tranche to portfolios. Before I close out this month's video, I want to leave you with this final chart of where U.S. stock valuations are compared to history, as it can help keep an even keel. Rising prices has the effect of creating giddiness and to lose focus on investment risk. The black line here is the S&P 500 index price, while the red line is the fundamental metric of the index's price to earnings ratio. As you can see, we're currently at the third highest level in history. The only two other times occurred just before the 1929 stock market crash, which kicked off the Depression, and the 2000 technology bubble burst. The good news here is that there's still a lot more upside if investors are going to push this silliness higher. The bad news is the higher we go, the bigger the decline when prices mean revert. Until next month, as always, appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with March 2017's Charts on the Move.